Stop staring at indicators that scream for attention and start listening to the only thing that matters, the flow of acceptance and rejection. In this session, I will show you how to read time, price, and volume as a single conversation so you can see where value forms and where it breaks. You will learn to classify the open, name the day personality, and act with a clear first-hour plan, without prediction, without ego. This is your turning point. Markets are not puzzles to solve, they are auctions unfolding in plain sight. Every session is a negotiation where buyers and sellers test levels, discover temporary fairness, and then move on when that fairness changes. Price is the path it takes, but the path can lie. Time and volume reveal preference. They show where the auction lingers, where it builds relationships, and where it refuses to stay. When a level gathers time and attracts transactions, the market is saying, this is acceptable value for now. When it catches a level and leaves quickly, it is rejecting that value. Read that conversation and you stop predicting and start interpreting. You begin to expect continuation where acceptance grows and anticipate rotation where value is balanced. You prepare for expansion when balance tightens and participation dries. The goal is not to call the future, it is to recognize the present clearly enough to take only the trades that fit the auction's current state. Here is how we will work today. First, you will learn a simple way to map the auction, so you can see where value formed yesterday and where it might shift today. You will mark reference levels from prior value, point of control, and extremes, and you will pair each level with a clear if-then decision. Next, you will practice classifying the open within the first half hour so you can set expectations for balance or directional drive without guessing. You will learn to read who is in control by watching range expansion, single prints, and the position of early trades relative to value. Then you will build a first-hour plan that defines entry triggers, invalidation, and scale management. We will stack daily and intraday profiles to keep a higher bias while you trade the current auction with precision. Finally, you will run a short review to capture lessons and prepare clean levels for the next session. When you combine these steps, you will replace noise with structure, and you will act with calm intent. Every single day. Most traders treat indicators like oracles, but indicators only echo what price has already done. Rethink them as translators that help you hear the auction more clearly when the context is defined. Without context, a crossover, divergence, or overbought label is random noise. With context, the same signal becomes a timing aid. First, establish value and acceptance using time and volume. Note where price spent energy and where it refused to linger. Then ask whether your indicator aligns with initiative flow or responsive rotation. An RSI divergence at a prior value edge after a rejection tail is useful. The same pattern inside the middle of value is usually churn. A moving average cross that occurs after a balance breakout with single prints can confirm continuation. A cross occurring inside balance often fades. Treat indicators as secondary, never primary. They refine entries, tighten stops, or help you avoid emotional impulse. If signal and context disagree, follow context. If they agree, act small, define invalidation, and let the auction confirm. Always map your levels first, and let indicators serve that map only. Time is the compass of the auction because it records where the market is willing to stay. When a level accumulates time, participants are saying this price is acceptable. When the market touches a level and leaves quickly, it is discarding that price. Think of time as the measure of comfort. Price can sprint through many levels in a few moments and still tell you little about preference, but steady time spent at one level reveals the center of gravity. Volume adds the second layer. Heavy volume with growing time says conviction. A crowd is transacting, value is forming. A quick burst of volume with little time often marks a test, a knock on the door, rather than a move in. Price is the traveler. It tells you where the auction has been, not whether the auction wanted to live there. Only when you read time and volume together can price movements be trusted. If time concentrates and volume builds near yesterday value, expect rotation until fresh information forces a shift. If time dries up at the edge and volume flips against the move, expect rejection and a return through prior value. If time migrates to new levels while volume persists, expect continuation and be ready to ride with clear risk. Use the triad as a simple loop. Map where time built yesterday and overnight. Note where volume stepped in and where it failed. Then watch today. Is time sticking or slipping? Is volume supporting or arguing? Let those answers guide entries, exits, and size. TPO makes the auction visible by turning time at price into a simple profile you can read at a glance. Each letter marks a 30-minute period, and each row marks a price level. When letters stack horizontally, it means the market spent time at that price, which is the footprint of acceptance. When letters appear as a thin column, the market passed quickly, which is a sign of rejection. As the session unfolds, you see a distribution take shape. A balanced day often forms a bell curve with thick middle and thin edges. A directional day often shows long single-print stretches that look like a spine with ribs. The point of control is the price with the most time, and it tends to act like a magnet as long as the auction remains balanced. The value area is the range that contains about 70% of the letters, and it is the comfort zone for that session. Tails at the extremes mark areas where the auction was tested and denied. When a new session begins, compare its developing profile to yesterday. Is value forming inside, at the edge, or outside? Inside suggests rotation. Edge suggests a possible test. Outside suggests the market is exploring new territory. By reading these simple shapes, you translate price action into structure. Value is the footprint of where the auction prefers to do business, not a mystical line, but the range where time and transactions accumulated. Start by defining yesterday's value area as the zone that held roughly most activity. Then note its point of control, the single price that hosted the greatest time. When today opens, compare the developing trade to those anchors.
In price builds time inside yesterday value, expect rotation toward the point of control because the market is comfortable there. If price accepts outside, building time on new ground, bias shifts with the migration of value, and the point of control often pulls along like a hinge. Rejection looks different, excursions with thin prints that fail to retain time. Acceptance is sticky. A rising value area with a rising point of control says buyers are winning the negotiation. A split signal, such as higher price but a stuck point of control, warns that movement is outpacing acceptance. Trade decisions follow the map. Favor fades back to the point of control when activity remains inside value. Favor continuation when value migrates and time sticks outside. Locate invalidation just beyond the edge that the auction refused to accept. Mark repair targets at old value edges where structure was left thin, and scale out as the auction returns to those magnets. Profile geometries tell the story of how value forms, migrates, or breaks. A balanced session often prints a bell-shaped distribution, thick in the middle where time and trade clustered, and thin at the edges where attempts were denied. This shape implies rotation and a pull toward the center of comfort. A directional session often stretches in one direction with long single prints like a spine, each additional letter confirming initiative control. A letter B shape hints at a failure by buyers near the top, a heavy lower body with a light upper tail, and the path of least resistance is downward rotation unless acceptance rebuilds. A letter P shape inverts that idea, a strong upper body above a thin lower stem, born from short covering that may continue only if value migrates higher. Tails at extremes record tests that were rejected.
If the tail holds and time does not rebuild beyond it, the extreme stands as a reference for invalidation. A split profile with two peaks can signal a market debating separate fair zones, and trade rotates between them until new information resolves the argument. Watch how the point of control moves inside these shapes. A migrating point of control leading price suggests acceptance, while a stagnant point of control during fast moves warns of poor structure that repairs. Balance is the market at rest, a period where participants test both edges and keep returning to the middle, building a thick core of time and trade. Imbalance is the market in motion, when one side overwhelms the other and range expands away from prior value, with thin prints and clean directional conviction. The transition between the two is rarely random. You can often see it building as rotations become shorter on one side, as countermoves fail to revisit the opposite edge, and as volume shifts from the center toward a boundary and stays there. Inside maturing balance, participation tends to fade and volatility compresses. That compression stores potential energy. A sudden expansion with single prints and a refusal to return is the release. Your job is not to guess the exact moment, but to prepare a map that says, if price accepts above this edge, you will stop fading and you will look for continuation entries. And if the test fails and value remains inside, you will favor rotations back to the point of control. In practice, that means defining a trigger zone just beyond the edge, waiting for time to stick and for volume to support it, then entering on a pullback that holds outside the former boundary. Invalidation sits just back inside value.
When the move is genuine, the profile will not rebuild inside the old range. The point of control will migrate, and responsive attempts will be absorbed. When those tells weaken, take profits and expect repair. At the open, the market reveals its daily intention faster than most traders realize. Think of the first 30 minutes as a diagnostic that classifies tone for the session. A drive open is a burst away from prior value or from the overnight core that refuses to return. Range expands quickly, single prints appear, and pullbacks hold shallow. Your job is to stop fading, wait for a pause that holds outside the broken edge, and join with defined risk. A test open probes a known reference, such as yesterday's value edge, the overnight high or low, or a composite ledge, then snaps back inside and begins to rotate. Expect two-sided trade with gravity toward the point of control unless fresh acceptance forms elsewhere. A rejection open starts with an attempt to leave prior value, but fails to build time beyond it. You will often see a tail at the extreme and a strong move back through the prior range. Favor fades back toward the center until acceptance proves otherwise. An open auction is undecided. Price rotates within a tight early range and trade clusters near the middle. Wait for the initial balance to complete, then trade the break only if time sticks and volume confirms outside. Always anchor your classification to location. Opening above value sets a different expectation than opening inside or below. If the open aligns with higher timeframe bias and acceptance builds, lean into continuation. If it conflicts and acceptance is missing, respect rotation and keep size small until the story is clear. Manage risk first.
A market day tends to wear one of 5 familiar faces, and naming that face gives you an edge. First is the normal day. It behaves like a patient negotiation. Range expands modestly, rotations are orderly, and trade drifts back toward the center of comfort. Favor fades at clean tests of the edges and harvest profits near the middle because the auction returns to fairness unless acceptance forms elsewhere. Second is the trend day. One side takes control early, range extends, and pullbacks are shallow. Stop fading, wait for a pause that holds beyond the broken boundary, then join with risk defined inside that line. Add only if value migrates with the drive and reduce when pullbacks begin to rebuild time against you. Third is the neutral day. It often begins like a trend, then reverses through the earlier extreme and traps late entries. Expect sharp two-sided moves and trade only at references with proven rejection. Smaller size protects you while the auction rebalances. Fourth is the normal variation day. It looks balanced, but the market quietly prefers one side. One edge breaks cleanly and the later session leans that way, yet rotations still appear. You can fade into the weaker side early, but respect the preferred direction and trail profits with a bias toward continuation. Fifth is the non-trend day. Range is narrow, volume light, and energy low. This day is a grind that builds structure for a later break. Keep risk small, favor quick fades, and mark thin areas as future targets.
Across all 5, location and acceptance decide the play. Match your tactics to the face you see and let the profile confirm before you size up.
Initiative activity is the market pressing new ground, taking price beyond prior value and refusing to give it back. Responsive activity is the market defending fairness, fading tests at the edges and rotating trade toward the middle. Identify who is doing the work. If range expands with thin prints and pullbacks hold outside the broken boundary, initiative traders are in control. If tests fail to hold time outside and trade keeps returning to the core, responsive traders are winning. Act only when location and behavior agree. With initiative control, wait for a pause that holds above a ceiling or below a floor, then enter on a pullback with risk just inside old value. Add only if value migrates with you and the point of control follows. Take profits as rotations deepen or as time rebuilds against your direction. With responsive control, fade tests of prior extremes that fail to keep time. Target the point of control or the center of value, and exit as acceptance forms at your entry. Do not fight initiative with blind fades or chase responsive rotations in the middle. Let the profile tell you when control changes. A shift from shallow pullbacks to deeper retraces, a pause that rebuilds time against the drive, or a point of control that stops migrating are signs of a turn. Failed auctions are the market's way of shouting that a breakout was not acceptance but a trap. They begin when price pushes beyond a known boundary, trades thinly, and then snaps back inside the prior range. The tell is not the push itself, but the refusal to build time in the new territory. You will often see a tail at the extreme, little to no rebuilding beyond it, and swift migration of trade back through the edge toward prior value. Treat that behavior as a gift. It tells you that late chasers are trapped and responsive participants have seized control. The clean trade is to fade the failed move back through the boundary with risk placed just beyond the tail. Then target the point of control or the opposite side of value depending on how much structure lies in between. Poor structure is the cousin of the failed auction. It is created when fast movement leaves thin prints and gaps that never hosted real two-way business. That thinness is structural debt. Markets tend to revisit and repair those areas when initiative energy fades. Your job is to map those thin zones during preparation and use them as magnets and scale points during live trade. If a drive pauses and begins to rebuild time directly in a thin zone, expect repair to continue. If the pause holds outside the thin area and value migrates in the direction of the drive, expect continuation and stand aside from repair trades. Always anchor decisions to time and volume. If time sticks and volume supports the return, lean into the repair. If time fails to stick and volume dries up, treat the move as a test and keep your powder dry. Stacking timeframes lets you see the forest and the trees without mixing them up. Start by defining the higher timeframe bias using weekly and monthly profiles. Ask where value has been migrating across those sessions, whether the point of control is stepping up or down, and whether recent breaks held acceptance outside prior composites. That gives you a directional backdrop, not a trade signal. Then drop to daily profiles to locate current value, edges, and repair zones. Finally, move to your execution timeframe, where you wait for behavior that aligns with the backdrop and the day's developing story. When timeframes conflict, slow down and prioritize the higher one for directional bias, while letting the lower one control timing and risk. If weekly value rises, but today opens inside yesterday value and fails to accept higher, treat longs as counter until daily acceptance returns. If monthly value is flat and daily is balanced, keep size small and favor rotations. Build a simple ladder for decisions. Bias comes from the highest relevant profile. Context comes from the daily composite. Triggers come from the intraday read of acceptance, rejection, and control. When the latter agrees, press your best setups. When one rung disagrees, cut size and require clearer evidence. Track alignment with 3 questions before each trade. Does higher timeframe value support my direction? Is today building acceptance or rejecting it?
Does the execution chart confirm initiative or responsive control at my chosen level? If the answers are not aligned, you wait, because patience is also a position. Clarity beats speed every day. Preparation is where professionals separate from reaction. After the close, review the session. What was the opening type? Who controlled the day? And where did value migrate? Mark the point of control, the value area, the extremes, the single prints, and fin zones signaling structural debt. Note which references held and which failed. Write a narrative that explains how the auction evolved and why it ended where it did. Update composite profiles to see the forest, then return to the daily to see the trees. From that story, sketch 3 scenarios for tomorrow with clear if-then logic. If the open accepts above yesterday value, you stop fading and look for continuation.
If it opens inside and rejects the edge, you favor rotations. If it opens below and acceptance sticks, you align with downside until repair begins. Translate scenarios into levels. For each level, define a trigger, a stop, a first scale, and a maximum loss you will tolerate. Near the open, check the overnight session to see whether time is building in your scenario or contradicting it. Scan scheduled events shifting participation and decide whether you will stand aside or reduce size. Read a checklist. What is the higher time frame bias? Where is today relative to yesterday value? What is the opening behavior? Who is in control? And where is invalidation? During the session, write a line each hour on acceptance, rejection, control, and any change in the point of control. After the close, grade decisions against the plan, archive profiles, and carry forward lessons for the next session. Your first hour plan begins before the bell by knowing exactly which references matter and what behavior would confirm acceptance or rejection at those references. At the open, you watch location first. If trade begins above yesterday value and stays there with time building, you act only with the higher side, you wait for a small pause that holds outside the old edge, and you enter on a pullback that fails to rebuild inside. If trade begins inside value, you expect rotation until acceptance shifts, so you fade clean tests of the edges and target the point of control, always stepping aside if time starts to stick beyond an edge. If trade begins below and acceptance holds, you mirror the first case with a downside bias. As this unfolds, you classify the open by behavior.
A drive keeps extending with thin prints and shallow pullbacks, so you join only after a pause that holds. A test pokes a known level and snaps back, so you trade toward the core with modest size. A rejection tries to leave value and fails, so you fade back through the range. An open auction simply rotates until one side proves it can hold time outside. Every entry has a defined invalidation just beyond the last place acceptance should not return. Size is small on the first attempt and increases only if value migrates in your favor and the point of control starts to follow. Scales are planned in advance at repair targets or prior edges. If behavior contradicts your map, you cut quickly and wait for clarity. The facilitator mindset is calm attention married to disciplined humility. You do not argue with price, you listen to participation. You are not a forecaster, you are a translator. Your job is to frame scenarios, wait for acceptance or rejection to confirm one of them, and then execute the simplest action with the smallest necessary size. You assume you will be wrong sometimes, and you plan for that before you place the trade. You define invalidation in neutral terms, and you honor it immediately. You scale only when value migrates with you, and you reduce when time builds against you. You treat boredom, fear, and euphoria as market conditions, not personal truths. You review to learn, not to justify. You protect your ability to show up tomorrow by capping daily risk today. You are loyal to process over opinion, evidence over ego, and context over headlines.
Download the first hour checklist and prep template in the description. Subscribe for market profile walkthroughs and share one chart where acceptance or rejection fooled you. Commit to one clean practice this week and come back with your results. This content is educational and informational only, not financial advice. Trading involves risk. Always do your own research and manage risk.